Hey there, deep divers. Have you ever scrolled through news headlines about banking regulations or market stability and wondered, what's really going on behind the scenes to keep our money safe and our economy humming? You're not alone. Our financial world can feel like, well, a labyrinth of complex rules. Today we're taking a shortcut to understanding a cornerstone of that world, the Financial Sector Regulation Act of 2017. And look, this isn't just for legal scholars, though you'll definitely find good stuff here. This deep dive is for anyone who uses a bank, has investments, or simply cares about how our financial system actually works. We're going to unpack its purpose, its key provisions, and what it truly means for your financial life.
That's right. It's a really comprehensive piece of legislation. Think of it as the master blueprint that brought order, safety, and fairness to what was previously a complex and sometimes fragmented landscape. We'll explore how it impacts pretty much everything, from the safety of your deposits to how financial institutions are, allowed to treat you.
Okay, our goal then is to decode this crucial act in a clear, engaging way. We'll highlight its purpose, its core mechanisms, and, importantly, its real-world impact. All right, let's unpack this. So let's kick things off with a fundamental question. Why was this act even created? What problem was it trying to solve? And what's the sort of big picture it's aiming for?
Well, historically, financial regulations were often a bit of a patchwork, weren't they? Sometimes reacting to crises rather than proactively preventing them. This act was really a direct response to a global need, especially post-financial crisis, to build a system robust enough to withstand systemic shocks. Its core purpose is actually pretty straightforward on paper: to achieve a stable financial system that genuinely works in the best interests of financial customers and supports balanced, sustainable economic growth. But it's a multifaceted approach, setting up a framework designed to promote several really vital goals.
And what are those big goals? Because financial stability sounds great, but it's, a broad term. What specific aims is the act trying to hit?
Yeah, good question. The Act clearly lays them out. Firstly, and crucially, financial stability. This means ensuring our financial institutions and market infrastructures, think things like stock exchanges or payment systems, can operate smoothly, even through tough economic times.
Making sure the lights stay on, basically.
Exactly, making sure the system doesn't seize up. Then there's the safety and soundness of financial institutions. That's about ensuring they're well-capitalized, managed prudently, so they don't take on excessive risks.
Okay.
But it goes beyond just the big institutions. A huge practical goal for you listening is the fair treatment and protection of financial customers.
That sounds really important for individuals.
It absolutely is. It's about making sure you're not exploited, you get clear information, and your rights are upheld. The Act also drives for the efficiency and integrity of the financial system, promoting fair competition, honest dealings. It also includes the prevention of financial crime, like money laundering, which is a huge global issue. And on a broader societal level, it champions financial inclusion, making sure more people have access to financial services and the transformation of the financial sector, trying to address historical imbalances.
Wow, that's a lot.
It is. And finally, it aims to foster confidence in the financial system overall and ensure the orderly resolution of designated institutions. That last one is key, essentially protecting depositors in banks through things like a deposit insurance scheme, which I'm sure we'll get into.
That really paints a powerful picture, a system built on resilience, trust, and fairness. So how does the Act actually achieve these pretty ambitious goals on a practical level? How's it structured?
Well, one of the most significant shifts brought by this act is what's called the Twin Peaks model of regulation. Sounds kind of dramatic. It does a bit, doesn't it? But it's really about how our financial world is supervised.
Can you explain what that means and introduce the key players involved?
Absolutely. This raises a really important question. How do you effectively oversee an entire financial sector, especially one as vast and interconnected as ours? The Act establishes two primary independent regulators, each with very distinct mandates. And that's the essence of the Twin Peaks model: two powerful, complementary authorities keeping watch over the system.
Okay, two peaks. Who are they?
First, we have the Prudential Authority, or PA. Now, this body focuses squarely on the safety and soundness of financial institutions. Think banks, insurers, other entities managing large sums of money.
So they're making sure the institutions themselves are strong.
Exactly. Think of them as the structural engineers of the financial system, making sure the foundations are solid, the walls are sturdy, the building won't collapse, metaphorically speaking. The PA is actually part of the Reserve Bank, and its job includes setting what are called prudential standards and supervising these institutions closely to ensure they have enough capital, manage their risks appropriately, all that structural stuff.
That's a great analogy. So if the PA is checking the building structure, who's making sure the people inside are playing fair? Not just with each other, but with us, the customers.
That's the crucial role of the other peak, the Financial Sector Conduct Authority, or FSCA. The FSCA operates as its own independent legal entity, what lawyers call a juristic person. This means it's separate from direct government departments, giving it, autonomy to protect you.
So it focuses on behavior.
Precisely. Its main objective is enhancing the efficiency and integrity of financial markets, and crucially, protecting financial customers. This involves promoting fair treatment by financial institutions, providing financial education, and generally ensuring good market conduct. It's all about ensuring ethical behavior and transparent dealings on the ground.
It sounds like a robust system, these two distinct pillars. But I can imagine some listeners thinking, doesn't having two separate authorities risk creating confusion? Or maybe gaps where nobody's looking?
That's a critical question.
How does the Act ensure they truly collaborate instead of just operating in their own silos?
Yeah, you're right to ask. The Act specifically mandates their cooperation and collaboration. It doesn't just hope for it. They have to enter into formal memoranda of understanding, MOUs, to define how they'll share information and coordinate their efforts.
Okay, so formal agreements.
Yes, and there's also the Financial System Council of Regulators. This is a vital forum where senior people from both the PA and the FSCA, along with other relevant bodies, get together, discuss common interests, and make sure they're aligned. And for the even higher level policy coordination, especially on consumer protection stuff, there's the Financial Sector Interministerial Council. So this collaboration is absolutely key to preventing regulatory gaps and ensuring a comprehensive, integrated approach.
So we've outlined the sort of day-to-day oversight, the Twin Peaks. But what about those financial earthquakes, the moments when things get really shaky? We've all seen global crises. How does this act step in to prevent the whole financial system from crashing down? What mechanisms kick in during those really dire situations?
Right, that's where the Reserve Bank's explicit and really vital responsibility comes in. Its job includes protecting and enhancing financial stability. If a systemic event occurs or looks imminent, think of it like that financial earthquake you mentioned, a crisis so significant it could rock the entire economy, that's when the Reserve Bank is empowered to step in decisively.
To restore or maintain stability.
Exactly. It's a crucial layer of national economic security, really.
So the Reserve Bank is the ultimate firefighter in that scenario. But what if a major financial institution, like a really big bank, is teetering on the brink of collapse? How does the Act handle that without causing wider panic or some kind of domino effect?
This is a critical area, and it's heavily influenced by lessons learned from international financial crises, believe me. The Act includes comprehensive provisions for the orderly resolution of designated institutions.
Orderly resolution. What does that mean in practice?
It means having a predefined plan for managing a failing institution to prevent that wider contagion. The goal isn't necessarily just to shut it down abruptly, but to do so in a controlled manner that preserves critical functions and maintains financial stability. For instance, the Reserve Bank can use what are called bridge companies to temporarily take over parts of a failing institution, manage its affairs.
Like a temporary caretaker.
Sort of, yeah. To ensure essential services continue while the institution's issues are addressed. This is a very real-world application of the Act, designed to protect the broader economy and, crucially, depositors.
Okay, this leads directly to that crucial and often anxious question for you, our listener.
Yeah.
What about my deposits? Are they safe? If my bank fails, am I going to lose my life savings? This is where the rubber really meets the road, isn't it?
It absolutely is. And this is where a critical safety net comes into play. The Act establishes the Corporation for Deposit Insurance, the CDI.
The CDI.
Its objective is clear: provide deposit insurance and support financial stability by protecting depositors. The CDI manages a deposit insurance fund.
And where does the money for that fund come from?
It's funded by regular premiums paid by its members' banks, cooperative banks, mutual banks. They all chip in. Now, the Act clearly defines which deposits are covered. It calls them qualifying deposits. And crucially, it states there's a limit of cover for these deposits.
So not necessarily everything, but up to a certain amount is protected.
Exactly. A certain amount of your deposits is guaranteed by the fund, offering vital real-world protection. Plus, there's something called the no creditor worse off rule.
What's that?
It's a key legal reassurance. It basically ensures that in any resolution process, a creditor or even a shareholder receives no less than they would have if the institution had just been wound up through the traditional, messier liquidation process. It's a robust system designed specifically to protect you, the depositor.
Okay, so we have the regulators, the PA and the FSCA, and the big picture of stability and crisis management. But how do they actually, regulate day to day? What are their tools? What are the specific rule books they create and enforce?
Right, the Act gives them a clear set of powerful regulatory instruments. These form the actual rule book. The PA, the Prudential Authority, issues prudential standards. These are aimed squarely at ensuring that safety and soundness we talked about, covering things like capital adequacy, making sure banks have enough money in reserve, and robust risk management frameworks.
So the technical stuff keeping institutions solid.
Precisely. These standards are the backbone of structural financial integrity, ensuring institutions don't take on reckless risks. Then, concurrently, the FSCA issues conduct standards.
And these are about?
These are all about ensuring the fair treatment of financial customers and the efficiency and integrity of the financial markets overall. This covers everything from how financial products are designed and marketed, how complaints are resolved, and importantly, preventing what the Act calls unfair business conduct.
Unfair business conduct. What does that mean specifically?
It means conduct that is materially inconsistent with fair treatment, or maybe deceiving, misleading, or unfairly prejudicing customers, basically acting badly towards you.
Got it.
And both authorities can also make joint standards on matters where the responsibilities overlap, fostering that collaboration we discussed earlier.
And these aren't just suggestions or guidelines, right? These standards have teeth.
Oh, absolutely.
What happens if institutions don't follow them? What are the consequences? And what powers do the regulators have to protect us?
No, these are definitely not suggestions. They carry serious legal weight. That's where the robust enforcement powers come in. Firstly, financial institutions and key individuals within them must be licensed to operate. And these licenses aren't permanent. They can be varied, suspended, or even revoked if conditions are breached or financial sector laws are contravened.
So step out of line, lose your license.
That's a critical practical implication. No license, no operation. Regulators can also issue directives.
Directives.
Yeah, ordering specific actions or telling an institution to stop certain conduct. And if a person in a leadership role has broken a financial sector law or, say, been involved in financial crime, the regulators can even order the removal of that person from their position.
Wow, that's quite direct.
It is. And the penalties for breaking the rules can be substantial.
Yeah.
The Act specifies fines up to, I believe, are $15 million or imprisonment up to 10 years for certain offenses. There are also other tools, like enforceable undertakings, where a person or firm formally commits to fixing something or changing their behavior.
Like a formal promise to do better.
Kind of, yes. And debarment orders, which can ban individuals from working in certain roles in the financial sector for a set period. All of this ensures significant real-world consequences for non-compliance, which directly protects financial customers and the integrity of the whole system.
Okay, with all this power in the hands of regulators issuing standards, enforcing directives, hitting people with penalties, how does the Act ensure accountability? How do we make sure they are acting fairly? And more importantly, how are your rights as a financial customer protected if something goes wrong? How can you seek redress?
This is a really critical aspect of the Act. It's all about promoting administrative justice and access to redress. The Act sets up two crucial independent bodies for this. Firstly, there's the Ombud Council.
Ombud Council, what do?
Their main job is to oversee and support various ombud schemes. The goal is to ensure that financial customers like you have access to affordable and effective dispute resolution. So if you have a complaint against your bank or insurer, there's a structured, less formal, and cheaper way to address it than heading straight to court.
Like a mediator or an arbitrator?
Similar, yes. The Ombud Council issues rules for these ombuds and can recognize specific industry ombud schemes, which helps streamline how individual complaints are handled effectively.
That sounds really reassuring for consumers, knowing there's a specific path for complaints. But what if you disagree with a decision made by a regulator themselves, or even by one of the ombuds? Where do you go from there to get a fair hearing?
That's where the second vital independent body comes in, the Financial Services Tribunal.
Okay, a tribunal. Sounds more formal.
It is. It's explicitly designed as an independent, impartial court of record. Its core function is to reconsider decisions made by the financial sector regulators, the PA, the FSCA, but also by market infrastructures and even the statutory ombuds.
So you can appeal regulatory decisions to them.
Exactly. It provides a crucial legal avenue for challenging these decisions. The tribunal is made up of members with significant legal expertise, including retired judges, plus people with deep financial sector knowledge. This setup ensures a fair, informed, and expert review process for decisions affecting individuals or institutions. It's a vital check and balance on regulatory power.
And does it help the individual understand the process?
Yes, a key practical implication here is that your right to reasons for decisions is explicitly protected by the Act. You're entitled to understand why a decision affecting you is made. This whole system offers a clear path for recourse and ensures no single entity has absolute power, reinforcing accountability across the board.
Let's shift slightly to talk about transparency. How does the public stay informed, and how is general oversight maintained across this complex regulatory landscape? The Act mentions something called a Financial Sector Information Register. What exactly is that, and why is it important for you?
Yes, the Financial Sector Information Register. This is a truly vital tool for transparency and public oversight. It's basically an electronic public record.
What kind of information is in it?
It contains all financial sector laws, all the regulatory instruments we've talked about, like prudential and conduct standards, and critical information like the current status of licenses held by financial institutions and individuals.
So I could look up my financial advisor on there.
Potentially, yes, depending on the specific licensing requirements. The real-world significance here is that the Act states this register is taken to be a complete and accurate record, unquote. That means you can generally rely on the information it contains. It facilitates easy access and searching by the public, empowering you to verify information and understand the regulatory landscape. It's all about demystifying the regulatory environment, making it less opaque.
That sounds incredibly useful. But in a world where data privacy is, rightly, a huge concern, how do these various regulators share sensitive information? You mentioned they collaborate, but how do they share info with each other or even with international bodies without compromising individual privacy or creating security risks?
That's an excellent point and a very important balance to strike. The Act includes very strict provisions for information sharing. While regulators can share information to effectively perform their functions, for instance, to prevent financial crime or maintain stability across borders, they must have proper safeguards in place to protect the information received. The Act explicitly says these safeguards must be similar to those required under the Protection of Personal Information Act, POPAA.
So strong privacy protections are built in.
Absolutely. It's a critical balance between robust oversight and individual privacy rights. Any unauthorized disclosure of the shared information is considered a serious offense under the Act, carrying significant penalties. And just as another layer, auditors also have a legal duty to report certain concerning information directly to the Prudential Authority. This acts as an additional check, maintaining the integrity of the financial system while still being bound by these strict confidentiality requirements. It's a complex framework, yes, but carefully constructed to balance oversight with data protection.
So we've taken quite a deep dive into the Financial Sector Regulation Act 2017. We've seen how it sets up this powerful two-pronged Twin Peaks regulatory system. You've got the Prudential Authority ensuring the structural stability and safety of financial institutions.
Right, keeping the buildings strong.
And the Financial Sector Conduct Authority focusing on fair markets and protecting you, the customer, making sure people play fair inside the building.
Exactly. And beyond that, we've highlighted the crucial role of the Reserve Bank in maintaining that overall financial stability, the safety net provided by the corporation for deposit insurance for your savings.
That CDI protection is key.
Definitely. And those clear avenues for redress and accountability through the independent Ombud Council and the Financial Services Tribunal, it really is a comprehensive framework designed to safeguard our whole financial ecosystem.
From the tough licensing requirements to the prevention of financial crime, this act really underpins so much of what keeps our financial world running smoothly and, importantly, fairly. It's clearly a living legal framework designed for a complex, always evolving financial landscape. The practical implications touch almost every aspect of your financial life, even if you don't always see it directly.
And what's fascinating, I think, is how the Act continually adapts. It introduces new mechanisms like that detailed focus on orderly resolution of failing institutions or the transparent information register we just discussed. It's clearly trying to respond to global financial challenges and better protect the public. It really reflects a deep commitment, I feel, to a robust, responsive, and ethical financial system.
For you, the learner, the key takeaway here is that this act is really a testament to the fact that even in a highly technical field like financial regulation, the ultimate goal, at the end of the day, is always about creating a more secure and trustworthy environment for every single individual. It's kind of like the silent guardian of your financial peace of mind. So here's a provocative thought to leave you with. Considering how interconnected our global financial system is now and how fast things like technology change, what might be the next big challenge? Maybe the rise of new digital currencies, crypto, AI, and finance, or some unforeseen economic shock. What will require this act, or others like it around the world, to adapt and evolve even further to protect financial stability and your interests? Something to think about. That's all for this deep dive. Thanks so much for joining us. We really hope you feel much more informed about the intricate but vital workings of financial regulation.